Why do people think they're going to make millions trading when they don't even have a business plan? And when they do have a business plan, they're over optimistic. Let's have a look at a typical mistake that they make to make sure you avoid it. First thing, they rightly and correctly say they will have a stop loss, and they'll say they won't risk more than 1% of their total capital because they read it somewhere. Okay, that's fine. If you're a hedge fund manager, 1% of your total capital maximum loss on a trade is absolutely correct. If you're a retail client, you're probably okay taking a bit more risk because you have very little capital. Now, let's assume in this business plan you're deciding whether or not to trade for the rest of your life. So you don't have this capital at the moment. You don't have £20,000 or $20,000. But it's a business plan. It's what you plan to get. So let's make this over-optimistic assumption that you will eventually get your hands on it. And maybe some of you have it already. So therefore, your maximum loss on any trade from the entry level to where the stop loss is hit would be 1% of £20,000, £200. If you can't keep up and you're lost, then just don't trade at all. But let's assume most of you can keep up with this simple mathematics. And a coin is right 50-50 on a trade. Let's say you're a tiny bit better than a coin. By the way, 60-40 is too optimistic for the vast majority of people. They'll probably be just as good as a randomly tossed coin. So win-loss ratio, nevertheless, they put down as 60-40. And that means they'll be right 60 times out of 100. Of course, most over-optimistically think they're going to be right 100 times out of 100 because they found the Holy Grail on a TikTok video. They're wrong. They'll be closer to 50-50. But let's just assume and keep going with this over-optimism for a while on why their business plan and their life plans on becoming a millionaire trading are wrong. Average loss is therefore £100. Now, they did listen to what hedge fund managers like me have been teaching. They bought my book, The Mind of a Trader. No, this is not a plug for the book. You can download it for free from alpeshpatel.com/links. So what they did is they said, well, we're going to add to winners because Alpesh says so and because the leading hedge fund managers in the world let their profits run. So their average win should be more than their average loss. Fair enough. The vast majority of them, of course, won't do this. Losers add to losers and they'll add to their losing positions, and they won't add to their winning positions or let their wins run, which is why they won't get rich trading. But let's just assume for a moment their over-optimism in their business plan continues. So that's what they do. And they say they'll do 100 trades just to work things out. And of course, you can practice this at home on a demo account yourself. So of course, 60 of those trades will deliver £18,000. Now, this is the point at which they want to drop out of school and, of course, have a career just on social media. They think they're going to be the next Andrew Tate. 40 will make losses. 40 of those trades will be losing trades. So there's your losses. What are you left with? Net profit, £10,000 per 100 trades. Simple enough mathematics. That's the point at which they over-optimistically think they're going to become day traders. You know, sit at home in their underpants, eating nachos, and just banging away on a keyboard. Most of them probably already do that, but not in the trading arena. 100 trades per week, 50 weeks a year, because the other 2 weeks they'll be on their private yacht. 5,000 trades per annum. The maths on that works out at they're going to make $500,000 a year. But they're not. They learned that the hard way, so they say, yeah, you're right, Uncle Alpesh, I'll ease off. What I'll do instead in my business plan is, instead of doing that, I'll keep the day job, whatever their day job is, which is probably lounging around at home. But anyway, let's assume they've got a useful day job. 100 trades per 6 months. They'll do 1 a day or 5 in a week. Far more sensible. 200 trades per annum, just £20,000 per annum they'll make, not the $500,000 they thought. I've got news for you. I've spelt out the maths for you. You're not even going to do that. Even that, I'm afraid, my friends, is over-optimistic for most people. So what is it? What are the reasons why they fail? Well, for a start, just don't do it. You're probably saying, well, what's the key answer, Alpesh? Don't do it. Key reasons: bad teachers, bad mentors. They're all over the place on social media. You don't need me to prove that. And thirdly is bad strategies. Actually, strategies are not the scarce resource. Capital is. What are they doing wrong? You can put it into the comments. I'll tell you now why they're over-optimistic and why they're getting so many things wrong. I've already told you some of them. Their win-loss ratio will not be 60-40. They'll get a few winning trades, and they'll call that winning streak their probabilities. They won't count the losing trades. They'll be right, like I said, 50-50. They won't be able to have average wins greater than average losses. That's critical. They won't follow the 2 rules I just already mentioned. that losers add to losers and winners add to winners. Anyway, I'll tell you more in future videos on what they get wrong and what you should be doing to get it right.